Alright, everyone, let's go ahead and get started. Let me introduce myself for those of you who I might not have talked to yet. My name is Jeff Kirk, and I am our Sales and Operations Manager here at Health Matching Account Services. So I'll be dealing with our training today, taking you through the webinar. And what we're going to go through is our website, okay? Because all the information we have available on the HMA is here on our website. So it's a great resource for both you and your clients. So we're going to go through here, look at a couple of the pages we have to go through the information. Now, we're going to go more in depth than what we have on your previous webinars that you've attended. Okay, now that you are fully appointed with us and you have your writing number and your enrollment link, we can now share some more detail about our crediting and how that works. Okay. So I'm excited to have you guys on today. I'm excited for you to be able to start marketing or selling the HMA to your clients. You know, it's a very valuable product. Can fit in with any market that you work in, and those are some things we're going to touch on today. Okay. So to get started, just want to spend about a minute to quickly go through kind of the history of the HMA and how we got here. Okay, so this was an idea that one of our owners had really going back to about 2010. You know, he saw a void in the market where there really wasn't a good option to cover first-star medical expenses. Okay, you know, buying down lower deductibles is very expensive, of course, as you all I'm sure already know. So that's why most people choose to go towards the higher deductible plans for a more affordable premium. But then the concern is, well, how are they going to cover that deductible? And you have gap insurance options like hospital indemnity plans, for example. I know those are pretty popular for a lot of agents to sell. But of course, hospital indemnity plans only cover a hospital confinement. And of course, there's very easy ways that you can spend thousands of dollars without having a claim on a hospital indemnity plan. Okay. And again, most hospitalizations anyways are 23-hour observation and discharge. And those are still going to run you a couple $1,000s. And again, your hospital indemnity plan is not going to pay out on that. So that's just one example of a gap product. But the point is, gap products are very limited in what they cover. So there's very little value. And most people just pay premiums every month for a gap product and never actually utilize it. Okay, so again, buying down to a lower deductible is really not a valuable option. Gap insurance products aren't very valuable. And then you have other medical savings accounts, like an HSA. An HSA does provide some good value. You do get a small tax deduction up front, and it's very comprehensive. Okay, so it's going to, there's no gaps in what the HSA will actually cover when it comes to medical expenses. But, the limitation is that HSA is still sitting in a cash account. And again, 90% of all HSAs are in just a regular savings account, only earning, a very minimal interest, if any. So the limitation on an HSA is simply there's no growth. And your coverage on an HSA is only what you've actually paid into it. So that's what one of our owners saw. Want to provide a better product, a better benefit to cover deductibles and other out-of-pocket expenses. And that's where he came up with the concept for the HMA. Okay, a couple of parameters we wanted is we wanted to be available for everyone. We didn't want any restrictions on who can enroll. Number two, we wanted to be very comprehensive, more like an HSA rather than a gap insurance product. We didn't want any gaps in the medical expenses we can actually cover. And number three, we want to be able to provide a better benefit than a cash account. Okay, so we came up with the concept of the HMA. We worked with Milliman, who's a premier actuarial firm. Worked with them for 3 years and ran millions of different simulations to determine our crediting schedule that we now have with the HMA. Then, when it was done being built in 2014, we actually first introduced the HMA as a limited benefit health insurance product. Okay, we're here in Texas, so we first took it to the Texas Department of Insurance and then several other state departments of insurance. But ultimately, after about a year, they came back and ruled that no, the HMA does not qualify as an insurance product. And the primary reason was that there's not enough risk. Okay, they looked at it, of course, there's no benefit in the beginning. It takes time, to build up that crediting. So they said there's not enough risk. So this is not going to be regulated as an insurance product. Instead, they ruled it to be a self-funding mechanism, and it is considered to be a medical savings account. Okay, and then finally launched it on the market in July of 2016. Okay. So, several key benefits. that we provide with the HMA. First of all, like I mentioned a minute ago, it is available for everyone. There are no restrictions on who can enroll. No age limit. There's no underwriting. No one has to prove health. It doesn't matter if they have health insurance or Medicare. This could even be sold as a standalone product if they don't have any other medical coverage. No restrictions on who can enroll. Also, it's very comprehensive. So let me actually go down to the page here on our website where we talk about the different medical services and expenses that we cover. So it starts with the same list that HSAs cover. And like I just mentioned, that already is very comprehensive. If you're familiar with HSAs, you know how comprehensive that they are. Pretty much cover all primary and major medical care, plus all of your regular ancillary expenses. And that's defined under the IRS Section Code 213D. That's what HSAs cover. Also the same list of expenses that the HMA covers, but because the HMA is an after-tax product, we're not bound by the IRS code. So what we also cover with the HMA are elective procedures. That could be cosmetic or plastic surgery, LASIK eye surgery, fertility treatments, elective dental, things like that. Okay, so already two things that we've checked off. It's available for everyone, and it's even more comprehensive than an HSA because we cover elective procedures. So already two tremendous benefits that the HMA provides. But now, the biggest selling point and the biggest purpose of the HMA is how we provide our medical benefit crediting. How we grow the account to where members are able to accumulate approximately a 2-for-1 benefit as their account builds up over 35 months. This is the selling point, this is the benefit, because this can't be duplicated anywhere else. Your regular savings account is available for everyone and covers everything, but our crediting is really what makes the HMA unique. Okay? And the way we do this is through actuarial science. Okay, like I said, we originally introduced this as an insurance product because it works just like an insurance product. Okay, so we are using a risk pooling strategy. So all the contributions that are being paid in each month by our members are being all pulled together by us. These contributions are paid to health matching account services. We're pulling those contributions together, which allows us to spread the claims risk across our members and award this increasing medical benefit crediting based on claims experience. Okay, so this growth has nothing to do with any type of financial return. Okay, there's no interest rate, of course, or there's no investment strategy that we are relying on because that would be impossible to sustain. But, again, by using actuarial science and insurance principles, we are able to build this benefit. Okay. Now, of course, a key restriction is that there is no non-medical use. Okay, so they can't just build up their account and decide they want to cancel their account and take their money back out, or build up and use that money to go on vacation or buy a car, put a down payment on a house. Can't do anything like that. Okay, so it does only cover the medical expenses that we list that we cover, which again is very comprehensive. So they will use this at some point. But the key is at no point is there any non-medical use. Okay. So the summary is, looking at this chart here, this breaks down the 11 different product options that we offer. Okay. And the point of having these 11 different options is that each one is designed to build up to this target account balance over our 35-month schedule. So HMA 2500 builds up to 2500, HMA 5000 builds up to 5000, and so on. So this allows your clients to choose the level that best fits what their needs are. Okay, so there's a lot of flexibility here. Some of your clients might just want to pick the HMA 2500, others might want to pick the HMA 40,000. Okay, but this gives them the flexibility based on what their situation is to choose the right product. All right. Also, these accounts can be individual accounts or family accounts. And for a family account, they're able to add a spouse and children up to age 26. Okay, then everyone would have access to that account balance. Those benefits can be used on anyone who's listed on the accounts. And then, as I mentioned just a minute ago, each of these different product options comes with a defined monthly contribution. And again, you want to think of these contributions as being more similar to insurance premiums than regular cash deposits. Okay, because again, they're not depositing that into an account in their name. They're paying that contribution to health matching account services. and we then credit their debit card with their account balance. Okay. And now, the way we award that medical benefit crediting is each month we are awarding a matching percentage. So every month they pay in their contribution amount, and then we're matching that contribution with additional dollars. And the 30,000 foot view, again, is as they make that contribution and as we provide that matching percentage, their account is designed to build up over 35 months, assuming they don't use it. So if they choose the HMA 2500, they're contributing $40 a month. So over 35 months, that would equal a total contribution of $1,400, and their account balance would have built up to $2,500. So our crediting would have added that extra $1,100. Okay, or if we look at the HMA 20,000, see they're paying in $251 a month. So over 35 months, that would equal a total contribution of $8,785 to build up to $20,000. Okay, so again, as you can see, providing a tremendous crediting here that builds up their account balance well above and beyond what they actually paid for. So they're getting this extra coverage that's building up. Again, use it to cover any copay, deductible, or co-insurance that they have. Also used for ancillary expenses like dental, vision, hearing, prescription drug costs, also elective procedures. Okay, so again, a very valuable product to sell to your clients. And essentially you want to, most of the time you're just selling this in addition to whatever major medical plan you're selling. Okay, so offer your clients, hey, here's a high deductible health insurance plan to minimize your premiums, and then here's your HMA, which is going to cover your front end. Or if you do Medicare, here's a high deductible supplement, or here's a Medicare Advantage, and here's the HMA to complement that, to build up to cover the out-of-pocket portions. Okay, so that's a strategy you want to take with this. Provide your clients with, the maximum amount of benefits at the minimum amount of costs.
Hey, quick question.
I see Howard here says, it seems to me that the monthly maintenance fee is a way of adding funds to the account to offset the missing value in the third year of crediting of about 3 to 1. Actually, the maintenance fees go to cover our costs, also go to pay commission and go to our profit. The crediting is all based on actuarial science. We're not investing any of this to make up for that benefit on the back end. It's just simply based on claims probability. And we're actually going to take a look at that next, because what I want to do now is actually break down exactly how the account builds up over 35 months. Okay, because the summary again, hey, you're paying into it, your contributions are being matched to build up your account towards that target account balance over 35 months. Okay, but the way it works is our matching percentage starts out very low in month 1. And then as they move forward, every month the account is not used, the matching percentage increases. Okay, so most of this growth that builds up, most of that crediting, does come on the back half of this 35-month schedule. So what I want to do now is take about 5 minutes and actually break down exactly how this works. Because we don't give out this information. Okay, there's no chart that we hand out to our members to show them exactly how their account grows, because we spent years and millions of dollars building this schedule. Okay, this is our proprietary schedule. It's trademarked and patent protected, and so we don't want to broadcast it out there. But I am going to explain right now exactly how it works, so you're able to, if you want to build a spreadsheet. I know we've had several producers do that. You don't want to hand it out to your clients, but if you want to use that as a sales tool, you can do that. So let's get into these numbers here. All right. First thing is our contributions are made up of 2 parts. Part number 1 is their medical contribution, or what I'm going to refer to as their base contribution. That's the amount that actually goes towards their account balance each month and then receives that extra matching percentage. Okay. Then the second part are the maintenance fees. Again, like I just mentioned, maintenance fees cover our costs, help pay commissions, things like that. So they're paying these maintenance fees every single month. Again, just like insurance premiums. Insurance premiums always have costs and other things built in, so do our HMA contributions. Okay, so now the breakdown of how you find that base contribution is you simply divide the target account balance they're on by 100. Or Think of it as simply knocking off the last two zeros of that target account balance, and that gives you what that monthly base contribution is. So for the HMA 2500, $25 a month. For the HMA 5000, $50 a month. HMA 7500, $75 a month. HMA 10,000, it's $100 a month, and so on. All the way up to the HMA 60,000, which would be $600 a month. So that's the amount that's actually going into their account balance each month. The remaining dollars of their contribution are the maintenance fees that we're taking out. That would be $15 a month on the 2,500 level, $34 a month on the 5,000, $38.50 on the 7,500, $40 a month on the 10,000, and all the way up to $125 on the 60,000. Okay. That's also the same maintenance fee they continue to pay once they reach their target account balance. So they're always paying in that maintenance fee every single month. Okay, and that sustains us, our company, to make sure we stay in business. Okay. Now a couple things about the maintenance fees. It's a much higher percentage on the early on the smaller levels. Okay, most of these fees are covering fixed costs that we have. So you see, $15 out of the $40, that's about a 40% maintenance fee. But by the time you get to the HMA 10,000, $40 out of 140 is about a 30%, and 125 out of 725 is only about a 20% maintenance fee. Okay, so there is better value on the higher plans because it's a percentage-wise, it's a much smaller maintenance fee, and that you can see that in the crediting. As far as, with the HMA 2500, doesn't quite double their money over 35 months because they're paying in 1,400, we're adding 1,100. But by the 10,000, they're right at about doubling their money. And on these higher plans, they're significantly more than doubling their money. So better value on the higher plans. But of course, not everyone needs to build up that high. So that's the breakdown of the contributions. So now, the growth comes from our crediting that we're adding back in each month. So I'm going to write this down on the left-hand side of the screen. It's a very simple crediting schedule. Okay, in month one, that match starts out at 10%. Then as they go forward, every month their account is not used, that match increases by 10%. Okay, so it's a 10% compounding crediting each month. Simple compounding. So month 3, that match would be 30%. Month 4, that match is going to be 40%. So if we skip ahead, by month 10, they're going to be receiving a 100% match. By month 20, a 200% match. By month 30, a 300% match. Okay, so the way this works is early on, they're actually going to start out with a lower account balance than what they're paying in because the maintenance fees are higher than the crediting that we're adding back in because we're only applying this match to their medical contribution or to that base contribution because, again, the maintenance fees are going straight to us. All right. So to kind of give you a quick example, and then we're going to look at the HMA 10,000. Let's take the HMA 5,000. In month 1, they're making that contribution of $84. $50 is going towards their account balance, then receiving an extra 10% match or an extra $5. So in month 1, their account balance would be $55. In month 2, again, we're just going to assume that they're not using it. In month 2, their account's going to grow by $60. That's their $50 contribution, plus an extra $10 from the 20% match. In month 3, it's going to grow by $65. In month 4, it's going to grow by $70. In month 5, it would grow by $75. So now if we fast forward by month 10, their account would grow by $100. Again, their $50 contribution, plus an extra $50 from the 100% match. In month 20, their account would grow by $150. And by month 30, their account would grow by $200. Okay, so yes, they are going to average that 2-for-1 benefit after 35 months, but In the beginning, they actually start with a lower account balance over approximately the first 6 months, but by the end of the first year, they'll start seeing those extra benefits accumulate. But most of that benefit does build up, on the back end of this 35-month schedule. Now, this is pretty overwhelming to look at. If you're sitting in front of a client for 5 or 10 minutes explaining this, you don't want to go into this much detail, okay? Because, again, they'll probably be pretty overwhelmed, probably easily confused, and, of course, they're not going to enroll if they don't understand it. So you do want to keep it simple for them. Just get kind of the basic fundamentals of how the HMA works. Again, start with, hey, look at this. This can double your money over 35 months. You get a very rapid buildup, much more so than any type of cash account. Okay, so this is the premier option to cover your deductible or whatever other out-of-pocket costs that you're looking at with each client. Okay, that's how you want to present it. Start with the 2-for-1 benefit. Then come back and say, now, you don't start out with a 2-for-1 benefit right away. That's just simply not sustainable. Okay, so the way this works is in the beginning, over approximately the first 6 months, you're actually going to start out with a slightly lower account balance than what you're paying in. So it's not meant to be used right away. There's kind of a built-in waiting period. But by the end of the first year, you'll start to see some extra benefits building up. And then, again, as you continue, every month your account is not used, your growth is increasing. So there is an incentive not to use it. We kind of want to wait to use it until you absolutely need to. You don't want to use the HMA for every little nickel and dime expense that you're going to come across. Instead, save it for when you actually have some of those higher claims that you can't easily pay out of pocket. All right. Now, a way to help you explain that and how the account works and what they need to know so they can visualize it is show them our example of the HMA 10,000. Let me go back up here to the HMA section. We're going to go down to an example of how the HMA account balance grows. Okay. This arrow, again, you see obviously it's here on our website. It's also in our brochure. It's on the John Goodman Forbes article as well that we're going to take a look at. So this is kind of a visual aid to help you explain how this works to your clients without getting into all the numbers. Okay. So show them here. So here's an example of the HMA 10,000. We're here, it's designed to build up to this $10,000 paid up benefit over 35 months if it's not used. Now, the way it grows, like I mentioned, is in the beginning, you actually start off a little bit of a lower account balance than what you're paying in. So here in month 1, if you were to pay in $140, your account starts out at $110. But in month 2, when you pay in $140, your account would grow by $120 to give you a balance of $230, even though you paid in $280. In month 3, your account would grow by $130. In month 4, your account grows by $140. Okay, so every month, your account growth is going to increase by $10. So by month 12, your account's going to grow by $220. By that point, would have paid in $1,680 to have a balance of $1,980. By month 24, your account's going by $340. Okay. So again, use this arrow to show them, hey, here's what you need to know about how your account works. Yes, you do get this 2-for-1 benefit, but that's the average over 35 months. In the beginning, this is not something you want to start using right away. It takes time to build up. I would tell your clients, hey, at least 6 months, but preferably, 12 months or even longer. Okay, so obviously this needs to be explained because, we have about a 97% retention rate. Okay, we only have about a 3% lapse rate over the first 3 years. But those 3% that canceled is because this wasn't properly explained. And they get 3 or 4 months into it, they check their account balance and say, wait a second, what's going on here? And then they want to cancel, even though they're already about, they're almost to month 6, they're about to break even anyways, but because, it wasn't sold properly or they didn't understand it properly, they decided to cancel. Okay, so it's important that they understand, hey, not meant to be used right away. This takes time to build up because in the beginning you're starting out with a slightly lower account balance. Okay. So, key to being able to explain that to them is using this visual aid here. Because again, this helps you explain it without getting into all the different numbers. Okay. Now, ultimately, our members can use their account whenever they want. And the way they use their account is through a prepaid Visa debit card that's issued and FDIC insured through Bancorp Bank. Okay, so, basically they use that debit card as a form of payment whenever they want to use it to cover an out-of-pocket expense. That could be going to the dentist, paying a deductible or a copay, paying for an elective procedure, whatever it may be. Okay. Now, there is an opportunity cost whenever they use it, because what happens is we always subtract however much they spend. So it reduces their account balance, but it also is going to reduce that matching percentage, because it's going to move them back down this 35-month schedule. So every time they use it, it's reducing their account balance, and it's reducing the crediting or that matching percentage back down as well. So that's why they want to be careful about how they use it, especially in the first year. Okay. So, I'll give you a quick example. Let's say here in month 2, they paid in $280, they have $230, and let's say they have a copay of $30 and they decide to use their HMA. Well, it's only $30, right? But that leaves them with a remaining balance of $200, which, even though it doesn't set them all the way back down to month 1, it still sets them back below month 2. So next month, which would be month 3, but because they had that claim, they're only going to get the crediting for month 2 again. So next time they pay in that $140, we're only crediting them with the $120. They get the value for month 2. So they would have $320 in their account. When if they didn't use their account, and in month 3, they would have a balance of $360. So see, the opportunity cost is not just the $30, but the extra 10% match that they are not receiving. And that set them back, again, a month on our 35-month schedule. Okay, so again, it's key that, the proper way to use this to really maximize the value is not to use it early on. Okay, wait, towards the end of year 1 or hopefully even into years 2 or 3 before they really want to use it. Don't want to use it on every little small expense. If it's something they can easily pay out of pocket for it. Okay, especially early on. Now, we've designed our HMA benefit this way for several reasons. And like I mentioned, we did work with a premier actuarial firm to do this. And number 1, it protects us from adverse selection. Like I mentioned, there's no underwriting, no one proves health. There's also no exclusions. We'll cover any pre-existing condition they have because this design is like a built-in waiting period. Okay, we don't have any risk in the beginning. Okay, that's also why, again, it's not considered to be an insurance product. It's because of the limited risk we actually take on. Okay, but it's key because this works as a built-in waiting period. Number 2, along the same lines, it's also a reason how we're able to have it to be such a comprehensive benefit because, again, it takes time to build up until they, actually have some extra value building up. Okay, again, a built-in waiting period for us. But then the third reason for this design is based on claim statistics. Okay, again, using actuarial science and claim statistics to build this benefit. But what we've done, instead of actual health insurance products that are designed basically on a year-to-year basis, we've designed the HMA to be, an ongoing benefit. And so we want to design it in a way that follows how claims naturally occur for most people. And it starts with the 80-20 rule, the kind of the basic formula that health insurance is based on, which says that in each year, approximately 80% of all claims come from only 20% of the people. So every year, only about 20% of people are going to be high claim filers. The other 80% are just going to be lower claim filers. So the majority of your clients are likely to be just a small claim filer over the next year. Okay, again, they're probably not going to have a need to use the HMA anyway. If they do incur claims, they're probably just small claims that they can pay out of pocket. Don't need to use their HMA anyways. So for most people, this kind of built-in waiting period isn't even an issue. Okay, because most of your clients are just going to be small claim filers anyways. But at some point, people are going to be high claim filers because the 20% of high claim filers is different each year. So your average person, or really even your average family, again, is likely to be a small claim filer in most years and a high claim filer only about once every 3 to 5 years on average. So we award our crediting and provide this benefit through the HMA based on how claims naturally occur for most people. Smaller claims in most years, or again, they're not really going to need to use their HMA, especially in that first year. They can build up into years 2 or 3, then use it to help cover those higher claims that typically occur only about once every 3 to 5 years on average. Okay, so just some things that how you can explain, because some of the frequently asked questions you're going to get here. Number one, how do we award this crediting? And that's when you have to talk about, well, this works more like an insurance product rather than like an investment product. This is not like your 401k or your IRA or your HSA. We're not relying on any outside return, financial return. Instead, this works more like an insurance product, okay, where you're awarded a benefit based on claims probability. Okay, and you can, kind of say, hey, most people are small claim filers in most years, higher claim filers once every 3 to 5 years on average. So this is more of a self-funded benefit that you use that's very comprehensive to help, again, cover your first dollar cost. Now, also need to explain, when you're answering that question is, a key to this is that there is no non-medical use. So it's not like you can bill up to $10,000 and then go on vacation, or put that towards buying, a new living room set, or putting a down payment on a house, anything like that. That's reserved, of course, only for the medical expenses that we cover. So those are keys into kind of covering that question. This looks too good to be true. How do they award this? Okay. Again, get them thinking of it more like an insurance product, and like life insurance. If they have a life insurance plan, it's not like they can take their life insurance benefit and use that to go buy, certain items, because it's a death benefit. This is a medical benefit. Okay. Another question: when you get into this design and you show them that, hey, you start with a smaller account balance in the beginning because that's like a built-in waiting period, they're likely to ask you, well, hey, can I dump in a lump sum? Can I just pay in? Let's just say I want to pay $1,680 up front, so I can just bypass that first year. Well, that answer is no, because again, the point of this design is it allows us to offer this, with no underwriting and to be very comprehensive. So we have to have this built-in waiting period in place for this to be a sustainable benefit. Because if we let people just dump in a lump sum, guess what they're going to do? They're going to wait until they're like, oh, I'm having a surgery tomorrow. Let me dump in $4,900 to get $10,000 so I can pay for it. Now, I mean, obviously, when you put it that way, of course, that would be impossible to sustain. So, this design is, of course, key to being able to provide the benefits that we do. So, no, there never is any allowable dump-ins. Okay. So those are some of the common questions you're going to get. Okay. Oh, I see another question that we just had here. Let's see. A couple questions here. So if somebody wanted to open an account and start using it 2 months, what's a comfortable percentage they could use? Well, I mean, they don't want to use it at all, because each time they use it, whether it's $5 or $100, it's still moving them back down this crediting schedule. Okay, so they don't want to use it at all over the first, 6 months to 12 months, really. Okay, but even then, let's say they're at $1,980, and then let's just say they spend $1,000 when they're at $1,980. So we subtract that $1,000, that leaves them with a remaining balance of $980. Now, as they get into the higher crediting, like by the back end of year one, that $1,000 claim that leaves them with $980, that actually only sets them back to month 7. Okay, but again, that's why it's key that you want to build up, because again, that's only setting them back to month 7. So to pay back in, 5 more months at $140, what is that? They're only paying in $700 to build back up that $1,000 benefit. So that just shows you already by month 12, by the back end of that first year, they're already starting to build up that extra value. They're in much higher crediting than early on, so that's why they want to wait to use it towards the back end of the first year. All right. If a client wants to build a benefit beyond their original schedule, how do they do it? Yeah, so that's actually the next topic I wanted to cover. And let me go back down to our different product options that we have. So, obviously, as I mentioned, HMA is designed to be an ongoing benefit where people can build it up and then use it when they need to, start building it back up, use it again, build it back up, use it again, potentially for the rest of their lives. I mean, they could really keep the HMA benefit for 20, 30, 40 years, okay, because they're always going to have out-of-pocket expenses. But, of course, there's situations likely to change over time. So we allow our members to switch to these different levels at any time. They can move up, they can move down, with the only exception is they cannot move down if their balance is already higher than that target account balance. Okay, so somebody has $3,000 in their account and they want to move down, they cannot move down to the 2,500 level. Their account balance is already higher than that cap. Okay, but the key is that, again, we are providing tremendous flexibility here. Because, again, we want our members to be able to, customize their HMA benefit based on what their needs are. And, again, those needs are likely to change over time. So, whenever somebody wants to, change a level, right now we have a form that they would complete. And they would select the level they want to move to, they turn that into us, and we manually process it. Hopefully in the future, we'll have it more of an automated system, but right now there's a form that they can pull off of their broker portal or something, our customer service can send out to them when they want to make a change. Okay. Now another question, or actually before I get there, going back to if somebody asks you if they can do a lump sum, again the answer is no, but because of the flexibility we have, they can start out at a higher level, pay that in for maybe 6 months, and then drop down. So that is one way they could potentially, kind of bypass those smaller months in the beginning, is by starting at a higher level. Okay. Now, another question you're going to get is, what happens when they reach that target account balance? Now, be careful. It's not just 35 months. It's only 35 months if they don't use it at all. But, if they use it a couple times a year, they're likely to build up closer to 40 months, maybe 45 months. And, of course, you're always going to have clients that never actually build up to that target account balance because they start using it too often, which is fine, okay? But it's not just what happens after 35 months. It's what happens once they reach that target account balance, okay? Because, again, as they start using it, that schedule is going to fluctuate. So whenever they reach this target account balance, two options are, number one, they can remain at that target cap and just paying that maintenance fee that we talked about earlier. $15 a month on the 2,500 level, $34 on the 5,000, $40 on the 10,000, $51 on the 20,000. Okay, so the advantage there is they've reached the cap they wanted, and now we're going to reward them by having them just paying the maintenance fee portion. Okay, so for perspective, think of actual health insurance products, gap insurance, actual, health insurance premiums. No other company is going to give you a break on your contributions or your premiums, when we're talking about insurance products, if you don't use their product for a certain period of time. So you really want to think of just being able to pay a maintenance fee is a very valuable benefit for them. Think about it, if they build to $10,000, now they have $10,000 and all they need to do is pay $40 a month to maintain that $10,000 account balance. I mean, that's a steal. You can't even get $10,000 worth of dental coverage for $40 a month. Okay, so that's actually a very huge advantage that we're able to do that we provide that option where they can just, pay in a maintenance fee to stay at that target account balance. Now, the other option they have is they could move up. If they want to continue accumulating, they could move up to a higher level. And we're already seeing people do that. Okay, because, again, it's taken 3 or 4 years to get to that target cap for most people. So, think of yourself, 3 or 4 years from now, your deductible, your annual max out of pocket might be higher. There might be some other things that come up and you need major dental work. So there's all kinds of reasons why people would prefer to move up. And that's fine as well. So they have those two options that they can pick depending upon what's best for this situation. Either just pay that maintenance fee or move to a higher plan. So again, a lot of flexibility we offer. Now here, question, are all funds backed by HMA or any other bank? So again, our cards, give you a quick rundown here. So when this was going to be insurance, when we introduced it as insurance, we had to show the State Department of Insurance that we had millions of dollars of reserves. You had to put up millions of dollars of reserves with the state for insurance products. So we had that in cash ready to go, saying, okay, we're going to give this couple $1 million to the state to hold on for reserves. But when it was ruled not to be insurance, we just simply took those reserves and we put them in our bank, which is Bancorp Bank. And that's also, that also holds all the contributions that we pull together. So when we got our license from Visa, we showed them, hey, we already have millions of dollars to back up the future benefits we're going to have. And that's why they're considered to be prepaid Visa debit cards, because we back it in cash. And that's also why they're issued and FDIC insured through Bancorp Bank, is because we back them in cash. So no, we don't have any outside or third-party backing. This is all backed by the cash assets that we have here in our company, Health Matching Account Services. Okay, because again, we thought this was going to be insurance to begin with, so we put together, a lot of cash, thinking this was going to be insurance. But now that it's not, again, it worked out because, again, it's a prepaid Visa debit card, and it's FDIC insured because we back it in cash. That's also important to tell your clients. That's another question: how are these funds guaranteed? It's because we have a protected escrow account with the money we need to back up our benefits. That even if our company goes bankrupt, we can't touch that. So their cards, the money, the value on their cards is secured. Okay, and that's regulated by Visa, by Bancorp Bank, and by FDIC regulators. That's how we get this to the market. Another question here. When they move up, how's the crediting handled? So similar to like what I mentioned after a claim, how we adjust that crediting based on what month they fall down to. A similar process applies for when they switch levels. Okay, because again, each of these different plans or product options has a set 35-month schedule. So when somebody moves to a different plan, whether they move up or down, we just place them at whatever month their balance falls to on that new 35-month schedule. Okay, let me give you an example here. Let's say somebody wants to start at the HMA 20,000. After 4 months, assuming they haven't used it, they would have a $1,000 account balance. They would have paid at 1,004, and they would already have 1,000. So the break-even point on the 20,000 is about month 4. But now let's say they want to move down to the 5,000 plan. They just started at 20,000 because they wanted to build up higher. So when they roll down, this $1,000 account balance is going to put them at month 12 on the 5,000 plan. So that's where they start. So again, when they shift to different plans, we just place them at what month that their schedule dictates. So you see, by doing that, they just skipped over 8 months. They went from month 4 on the 20,000 plan to month 12 on the 5,000 plan. Okay, that's why starting at a higher level is a great strategy for those that want to build up faster. Okay, again, that's kind of strategy. If they ask you about a lump sum, say no, but here's what we can do to build up faster. Okay. All right. Hey, I need to switch gears here. I need to go into the actual enrollment process. Okay, so let me go here. And the enrollment process is very simple. All of you received an email like this. Now, this is just a sample email, because I don't want to get into anybody's information. But all of you received an email like this that includes your writing number and your enrollment link. So this enrollment link is how you sign your clients up. There's no paper forms. Everything's handled online through this link. So you can copy this link and email it to your clients. You can post on a website if you have one. And of course, if you're meeting face-to-face, you can click on it to pull it up. But this is how the enrollment's done. So of course, first step would be to just simply click that link or have your clients click that link. And that's going to pull up the enrollment page. Now, the key to that link is your writing number is built into it. So your link is unique to you. That's how we track your sales and commissions. So also, again, key to that, that's how we track your sales and commissions is through your enrollment link. So make sure that's how you enroll your clients. Okay. So you see here the link takes them to the enrollment page. And if you want to double check, you see that your writing number is going to be built into the URL up here at the top. All right. So you see it starts with the chart that has a breakdown of the different product options that we offer. Also below some information. Okay. Now, a key that I want to point out is I mentioned they can add family members. But on most of our plans, there are extra charges for family members. It's a very, very small charge, but still a charge. So what this says here is that on our first two levels, the HMA 2500 and the HMA 5000, there are no additional charges for family members. Okay. But starting at the 7500 level and higher, it's an additional $5 a month for the first dependent and an additional $10 for two or more for a total of $15. Okay. So what that means is, looking back here at the different product options, first two levels, there's no charges for adding family members. But at the 7500 level, it's an extra $5 to add one person, like a spouse, for example. It would be an extra $15 to add a family. So an extra $5 for one, extra $15 for two or more. Now, once they're ready to choose a level, they simply click on the green sign up button. So let's say they want to start with the HMA 20,000. Let's say there's a family. And they are going to do the HMA 20,000. They're going to click sign up. And that's going to take them to the next stage, which is where they're going to actually enter some very basic information to get their account set up. And when I mean basic, I mean we don't even ask for a social security number. Okay, so it is a very simple enrollment. Okay, so you see here, they're going to start by entering their name, email, and phone number. Now, one thing I will point out, they do have to have an email address. Okay, all the information we send out to them is through email, not by the actual physical mail. So they have to have an email address. Now, if they don't have one, you can create one for them. You cannot use your own for them because, again, there's important information about their accounts to do this. But name, email, phone number. Then they'll click on continue. Then you see the next sections where they're going to enter their address, date of birth, and gender. So again, very basic information. Now to add family members, you see there's two buttons here, to add adult or add child. So if they want to add a spouse, they click on add adult. When they do that, it just simply populates another field. Same thing for when they click add child. Simply populates another field. That's how they enter their family members to make sure they're listed on the account. Next step is to set up their payment method. Now, a couple things I want to point out here. First of all, they're setting this up on an automatic recurring basis. Okay, we're not actually billing them each month and waiting for a manual payment. This is setting up to be automatic. Okay, and they can set this up either through a bank account, and we'll do an ACH draft, or they can enter a debit or credit card to make that payment. Okay, there's no extra cost for a credit card. Okay, so again, very flexible with the payment method. Last thing they have to do is there's one agreement that they have to check off. And this goes back to why they need an email address, is because we send out all the information electronically. Okay, nothing actually gets mailed to them except for their actual debit card, simply because we have to do it that way. And then they're done. Then they just click sign up. And that's the entire enrollment process. So again, it's very simple. It only takes maybe 2 or 3 minutes to get somebody signed up here into the HMA. Okay, so tremendously easy and convenient. Now, what's important for you to understand is what happens next. Okay, and also I would encourage all of you to enroll yourself if you haven't already, so that you go through the enrollment process and then you actually see these next steps. And of course, you get the benefit and commission for your own sales, okay, on your own account. But what happens next is, in real time, within a few minutes or so, your client is going to receive an introductory email. And this is just to confirm their enrollment, but it also lets them know what's going to happen next. And tells them the next thing is that a few days later, basically once their payment clears, they're going to receive the welcome email. Now this is important because the welcome email is really what they want to be looking for. Again, typically it's going to arrive a few days later after they sign up. Okay, and that welcome email is going to have their member ID number. It's going to have their HMA contract attached as the PDF, and it's going to have instructions on how they set up their online member portal. Okay, all three are very important things: member ID, their HMA contract, and steps to setting up their online member portal so they can track their account balance. And then the third thing that happens is they'll receive their debit card in the mail about 7 to 10 days after they enroll. Okay, so again, to recap, once they sign up, immediately they're going to receive a basic introductory email to confirm enrollment. A couple days later, they're going to receive their welcome email, which is really what they want to be looking for. And about a week or a little bit more than a week is when they'll receive their debit card in the mail. Now, as you as the agent or broker, you receive a confirmation email at the same time they receive their welcome email. And basically that goes out once their payment clears. So you will be notified as well of enrollment, again, if you're not already aware. Okay, but again, definitely encourage, everyone here, if you're newly appointed with us like all of you are, I do encourage you to go through this process. You don't have to, but, it'll get you more comfortable with it. You'll get commission on your own sales. And really for sales, when you talk to your clients, you can pull out your debit card and say, hey, I have it. This account's great. You really need to get on this. I did. So it'll definitely help you with your sales as well. Okay. Now the last thing is I do want to quickly go into our broker portal. So I got about 5 minutes left. Also, while I'm doing this, if anyone else has any other questions, start typing those into the chat box. Or, we're going to be talking as you move forward. This isn't going to be, okay, this is your training, now you're done. Good luck. We'll be in contact, of course, but, I do want to try to get as much answer today as we can. But back to the broker portal. Advertising limitations. Well, we do have a compliance review form. So if you're building your own marketing piece, you need to run it by us first. As far as using anything on our website or anything here on our broker portal that we're about to get into, no limitations as long as it's one of our pre-approved materials, either on our website or on our broker portal. But if you're going to create your own, you got to run it by us. So to get to your broker portal, 2 ways to do that. I just did it. When you're on our website, you can go under Benefit Advisors and then log into the HMAS broker portal, or you can just simply go directly to it, which is powersalesleader.com. Now again, all of you I think are already on, so let me just log in here, because it looks like all of you already logged back on, requested access to the broker portal, and looks like we have granted access to all of you. So that's good news. So when you log in, it'll come to this page, and it'll say, welcome, your name. So important things to look at. Commission reports. Okay, click on this. That takes you to our commission portal where you're able to track your commissions. Okay, I was just on the phone with Timothy. We went in and looked at his just before the call here today. Next step, training and sales materials. We have 5 steps to selling. We have our HMA videos, brochures, HMRA videos, supplies, instructions for your brokers. So, if you plan on bringing in other agents in your downline, you can click on this, instructions for your brokers. And basically, everyone goes through that same first process where they come here to powersalesleader.com, request contracting, set up their broker portal, and do it through DocuSign. And so what you can do is you can send them our broker contracting manual. You can download that, send them that. Now the key, and I want all of you to remember this if you plan on bringing agents in your downline, is once they actually get to the DocuSign paperwork, the second page, really the first thing that they enter, is the broker referral form. That's where they're going to need to enter your name. That's how we know that they belong in your downline. So you can send the broker contracting manual that walks them through the steps, but also make sure that they enter your name in the broker referral form. All right. Again, that's under our training and sales materials tab. Last thing I want to talk about is here under quick links, order supplies. Let me click on this, and a couple things I want to cover here. First, we have these links that give you the ability to download all the PDF materials we have. Okay, so these are all our pre-approved marketing. We also have sales scripts in here to help you out as well. If you want to read through those to kind of help give you some ideas. So any of these you can use. Also, again, links to our website are great. All right. Now, if you have your own advertising you want to put together, and we have several people who've done that, we have here at the top our compliance review request form. Complete that form, send us what you're going to use, and if we approve it, we'll let you know, and then you can use that. Then also at the very bottom here, we have our supply order form. This is where you can actually order hard copy materials. So again, this page you can download the PDF by clicking on the link, and you can use that to email to people, or if you want to print out, or you can order here from our company. We'll mail you out hard copy supplies. Okay. All right, so good. That pretty much wraps it up. I have another call coming up here at the top of the hour, so I do have to run. But again, everyone, I appreciate your time. Hopefully this helped answer a lot of questions. And then if you do have more questions, feel free to shoot me an email. You can call here into the office if I'm tied up. For most of the day, I am tied up on calls or other things that I'm doing in meetings. You can talk with one of our representatives, but of course, we want to be able to assist you in any way we can. Okay, because the HMA is a great product, and we want to make sure that you're able to get it out to your clients. All right, so good. All right, everyone. Well, again, thank you for your time. I got to close down the webinar now, but I'm sure I'll be talking with each one of you at some point here in the future, in the near future, I should say. So good, everyone. Thank you. Have a good day.